One of the biggest factors that determines the success or failure of a fintech startup, in fact any tech startup, is regulation. Imagine having a revolutionary product idea, building it into a CVP or prototype, assembling a team, grinding to find capital, and going through the hassle of getting customers to test out your product, and then suddenly you're hit with a tangle of complex regulatory hurdles that constrains and completely strangles your business. And that is why regulation is one of the key aspects that any startup, particularly fintechs, should pay attention to if they do indeed wish to achieve success. Regulation is certainly not a negative factor, and there have been instances where enabling regulation has propelled even greater innovation. However, it can be a double-edged sword that needs to be managed both delicately and responsibly. So in this video, we'll break down the intricacies of fintech regulation. We'll unravel the mysteries behind these rules, explain why they are necessary, and chat about both the challenges and opportunities regulation creates. So whether you're a fintech enthusiast, fintech entrepreneur, or just curious about how the fintech world operates, I'll do my best to share with you a quick guide that will equip you with the knowledge to stay ahead. If that sounds interesting to you, then let's get started. Hello friends, welcome back to the channel. My name is Jeremy, and if you're new here and haven't yet subscribed, please consider doing so, because on this channel I speak about fintech, digital transformation, and agile strategy. Now, regulation refers to the set of rules and guidelines established by authorities to control and manage activities, ensuring they adhere to certain standards and principles. Now, these rules are enforced by regulatory bodies to maintain order, protect public interest, and promote fair practices. Now, in the context of fintech or financial technology, regulation involves creating and implementing policies and standards to govern the use of technological innovations in financial services. Fintech regulation aims to ensure that new financial products and services are safe, secure, and fair for consumers, while fostering innovation and maintaining the stability of the financial system. Now, let's talk about why fintech regulations are necessary. Imagine a world where there are no rules in finance. It would be absolutely chaotic. Even with strict rules in place, we've seen instances of financial chaos despite existing regulation. The 2008 global financial crisis, for example, highlighted significant regulatory failures and the severe consequences of having regulations that weren't adequately enforced or were quite simply bypassed. Let's look at another prime example. Mt. Gox was established in 2010 in Tokyo, Japan, and quickly grew to handle 70% of all Bitcoin transactions globally. It was a pivotal platform for the growing cryptocurrency market, which offered users a place to buy, sell, and trade Bitcoin. At the time of its operation, there was minimal regulatory oversight of cryptocurrency exchanges. Mt. Gox operated in a largely unregulated environment, which allowed it to neglect security protocols and financial transparency. Now, this lack of regulation meant there were no stringent requirements for protecting user funds, auditing financial records, or ensuring the overall stability of the exchange. Mt. Gox experienced numerous security breaches over the years, leading to significant losses of Bitcoin. Now, despite these incidents, the exchange continued to operate without implementing adequate security measures or regulatory oversight. In early 2014, Mt. Gox suspended trading, closed its website, and filed for bankruptcy protection. The company announced that it had lost around 850,000 bitcoins, worth approximately $450 million at the time, due to hacking and poor management. The collapse of Mt. Gox led to massive financial losses for users, and thousands of investors were left without recourse because their funds were either frozen or entirely lost during the bankruptcy proceedings. Now, this event significantly shook confidence in the cryptocurrency market, and in response to the debacle, several countries began to consider implementing regulatory frameworks for cryptocurrency exchanges. Japan, for instance, introduced new regulations requiring exchanges to register with the Financial Services Agency (FSA) and adhere to specific security and operational standards. Globally, the incident prompted regulators to take a closer look, leading to increased scrutiny and the development of more robust regulatory measures to protect consumers and maintain market integrity. So to bring it back, the key objectives of fintech regulation are: 1. Consumer protection. The goal is to safeguard consumers from fraud, data breaches, and unfair practices. 2. Is market stability, ensuring the financial markets are operating smoothly and preventing systemic practices. 3 is ensuring fair competition. Regulation seeks to prevent monopolistic practices and to promote a level playing field for all market participants. And 4th is promoting innovation. Now, believe it or not, regulation does seek to create a regulatory environment that encourages technological advancements and competition. You now have regulators creating fintech sandboxes which allow them closer proximity with fintech players to oversee and sometimes participate in the innovation, allowing them to draft and implement policies that support innovation. The PSD2 or Payment Services Directive in Europe is a good example of enabling fintech regulation. The PSD2 is a regulation implemented by the European Union to enhance consumer protection, promote innovation, and improve the security of payment services across Europe. The key features of this directive are firstly, open banking, because it requires banks to open their payment services and customer data to third-party providers like fintechs, fostering innovation and competition. This directive has contributed to the rise of open banking, enabling fintech companies to offer innovative financial products and services by accessing customer data held by banks. This has increased competition and provided consumers with more choices. Now, on the other hand, some smaller banks and fintech firms have struggled with the cost and complexity of complying with PSD2, which can have an inverse impact of rather stifling innovation and market entry for new players. Now, this leads us to the unique challenges in fintech regulations. Regulating fintech isn't the easiest thing to do and has its challenges. One of the biggest challenges is balancing innovation with regulation. Fintech is all about innovation, and too much regulation can indeed stifle that innovation. So it's a delicate balance. Also, there is the issue of global disparities. Different countries have different regulatory environments, which can be a nightmare for fintech companies looking to scale and operate internationally or across borders. Navigating these varied landscapes requires significant resources and expertise, because what may be absolutely fine in one country or state may not be once you cross the border. And let's not forget the rapid pace of technological change. This is the reason why regulations often lag behind technology, making it difficult for regulators to keep up. Just as the regulatory authorities are wrapping their heads around a blockchain or metaverse technology, then AI startups pop up using the technology in revolutionary ways. This leads to outdated or lagging regulations that don't effectively address current risks. However, regulation does create opportunities as well. For one, clear regulations can lower the entry barriers for new players and foster a more competitive market. We've already seen the example of PSD2 in Europe. Regulations also enhance security. They typically mandate robust cybersecurity measures, protecting consumers from fraud and data breaches. This not only safeguards personal information, but also increases overall trust in digital financial services. Lastly, regulations boost investor confidence. When there's a clear regulatory framework, investors feel more secure putting their money into fintech ventures. This influx of capital can drive innovation and growth in the fintech sector. So now let's talk about what makes for effective fintech regulation. There are a few key aspects to consider. Firstly, regulations need to be proportionate to the risks involved. Over-regulation can be as harmful as no regulation. It's about taking the time to find the right balance that matches the risk associated and enables creativity without unnecessarily restricting progress. Secondly, flexibility is crucial. Regulations need to be adaptable to keep up with technological advancements. Static regulations can quickly become outdated. The speed of regulation is also quite important because the nefarious actors aren't waiting for regulation to catch up. And finally, collaboration. Regulators need to work closely with industry stakeholders to create balanced regulations that protect consumers without stifling innovation. We already have seen some encouraging progress in this space with the creation of fintech sandboxes by numerous central banks. Now, if you were a fintech startup looking to grow and scale your business, here are some recommendations to safeguard your business as far as regulation is concerned. The first would be to understand the regulatory landscape. You need to thoroughly research and understand the specific regulatory requirements applicable to your sector or domain of fintech and your geographic location. This includes compliance with financial, data protection, and cybersecurity laws or policies. Second, you need to engage with regulatory bodies. You need to establish open lines of communication with relevant regulatory authorities. Now, I know this may not always be the easiest thing to do because regulators can be a difficult group to engage with. However, you should always bear in mind that they are just people like you and I who just happen to be incentivized differently. So maintain the highest level of respect in your engagements with them, and And if you're foreign to a territory, it's best to seek local counsel in your engagements so the cultural nuances that you are unaware of don't become the unspoken blocker to your progress. If there are regulatory consultations or sandbox programs offered, do try your best to participate to stay ahead of regulatory changes and to ensure that you're fully compliant. Next is that you must implement robust internal compliance programs. You must develop and maintain comprehensive compliance programs that include regular audits, risk assessment, and staff training. Ensure that your compliance framework is dynamic and can adapt to evolving regulations. Also, you need to leverage technology for compliance. Utilize RegTech solutions to streamline and automate compliance processes because these technologies can help in managing reporting, monitoring transactions, and detecting suspicious activities in real time. And finally, foster a culture of transparency and accountability within your organization. Regularly disclose relevant financial information and ensure clear documentation of all compliance activities. Now, looking ahead, there are several trends to watch in fintech regulation. With the rise of AI and machine learning, new regulatory frameworks will be developed to address the unique risks and opportunities these technologies present. There's also a move towards harmonizing regulations across borders. As fintech becomes more global, consistent regulations will help create a more seamless and efficient global financial system. We are also going to see an increasing focus on consumer data protection as more financial transactions move online. Robust data privacy regulations will be essential to protect consumers. And lastly, regulators themselves will start to leverage technology more to ensure they are able to track compliance to their own regulatory standards. Supervisory technology or subtechs are increasing in popularity because they enable regulators to automate compliance tracking and adherence to regulatory standards by the entities they oversee. I hope you found this video valuable, and if you did, remember to hit the like button and leave me a comment. Thanks for watching, and I'll see you in the next video. Cheers, guys.